We have talked about the general fund in the governmental fund, and we also have other important governmental fund. Right? We have capital project fund, we have debt service, we have special revenues, we have permanent. So in this lecture, we talk about capital project fund and debt service fund. So first, capital project fund. Governments must maintain capital project fund, resources that are legally restricted, committed, or assigned to expenditures for capital outlays. Okay, so capital project fund, the fund balance could be restricted, committed, or assigned. The CPF, capital project fund, is required if capital outlays financed from general obligation bond proceeds. Okay, in this case, it's required if we issue general obligation bond to have capital outlays, then CPF is required. So basis of accounting. Again, we're going to use modified accrual basis because this is a governmental fund. And to report a CPF in a government-wide statement, we're going to use the full accrual basis. Full accrual basis. So there's adjustment, okay? So if we have the convert the CPF to government-wide statement, we need to make adjustment. There are two types of capital project. One is a general, which is for public benefit. For example, we have public buildings, roads, highways. Okay, these are general capital project. We also have special assessment. It's going to give some private benefit, okay, to citizens in a specified benefit district. For example, there are street improvement that benefit a group of people, curbs, sidewalks. Okay. So let's talk about transactions in CPF fund. So we start with authorizing the project and recording the budget, right? Then we're going to issue the bond. Then we're going to transfer in the premium. If we have the premium issue bond, we're going to transfer the premium to the debt service fund. Encumbering available resources, a part of the budgeting process. Recording grants, if we have additional source from grants. Then we spend money, we're going to record expenditures. Right? If we invest money, we're going to record our investment earnings. And finally, we're going to close account. So let's talk about these transactions. Budgeting. So we know budgeting is used for all the governmental fund. The budgets help ensure controls. Since CPF has project focus, it may be unnecessary to make annual budget, okay? Because most projects will take more than a year to complete. So this budget is different from the budget for the general fund. But since numerous projects are integrated into a single fund, budgetary accounts help control individual project expenditures. So GASB requires budgeting over integrated funds. when control cannot be established by other means. For example, a government elects to adopt a budget and integrate into its account. Right? So just like the budget for the general fund, we're gonna debit all the estimated revenue, right? Here we have two sources. We're gonna debit estimated bond proceeds and debit estimated grants. Both are the source, revenue source. We're gonna credit appropriations. This is the expected expenditure. Right? The difference between them is budgetary fund balance. If the total source is greater than the expected expenditure, we have increased the fund balance, right? So we're not going to talk about the budgeting anymore. Review lecture 3 for budgeting and accounting. Next, let's talk about financing. As you can see, we have two sources, right? Generally speaking, for a government project, we have tax-supported debt, we have grants, and other forms of financing. And for tax-supported debt, right, most likely it's a general obligation bond, which is tax-supported. So we use the future taxes, right, as something like a collateral. Not collateral. It's we use a tax money to pay back the bond. Basically, use a tax money to pay back the bond. Or you can use a special tax restricted to payment of debt. Right? For example, if you want to just set up a project for a group of people, then we're gonna issue. We're gonna have these special taxes. Okay, special taxes restricted for that project. Tax-supported debt. Voter approval is required. And the proceeds are recorded in these other financing sources. Right? We have seen this in the previous lecture. And sometimes when we issue bond, we will have either discount or premiums. The difference between the face value of the bonds and the cash received, right, will be recorded as a premium or discount. And also we need to record the issue costs. Okay, I'm sure we have seen these in intermediate accounting already. Types of bonds issued. Term bonds, in which principal matures in one lump sum amount at the end of the bond term. The term bonds are not used as frequently for municipal financing as serial bonds. Why? Because we need to pay one lump sum amount at the end of the term. Then usually we need to set up a sinking fund. And that's our investment. We need investment management, right? And if we have a sinking fund, there's additional reporting issues so it's more complex to use term bond. Usually for municipal and for government accountings, we're going to see more serial bonds, in which principal matures in annual installments. For serial bonds, the amount of budgeted for revenues or interfund transfers in is usually just what is needed that fiscal year for matured principal and interest. And also its advantage, right? Self-amortizing, no sinking fund needed, and it's easier to fit budget. Okay, so in the budget, we just find out the needed principal and interest payment for this period, and we make the budget, and that's it. Okay, let's see how we're going to record the bonds issued with premium. Assumed bonds with face value 5 million were issued at 101 to finance the project. So in the capital project fund, we're going to record the following journal entry. We debit cash, right? This is a 5 million multiplied by 101%, right? We credit other financing source, bond proceeds. And the premium is recorded as other financing sources, bond premium. Next, we're going to do something about a premium. So why we get a premium? We get a premium because we set our interest rate for the bond. It will be higher than the market rate. That's why we have a premium. So because we're going to pay higher interest, so the premium can be viewed as a prepaid interest, right? Because we're going to pay investors high interest. So this is a so we get a premium, but eventually these premium will be returned to investors. So the next thing we're going to do, we're going to transfer the premium to debt service fund, because eventually we're going to return this. We're going to pay back the interest to investors. So the next journal entry is we're going to transfer it to the $50,000 to the debt service fund. So debit other financing use. Debit other financing use. This is opposite to other financing sources. Debit other financing use. Transfer of bonds premium to debt service fund. And a credit due to debt service fund. So this is a current liability. And if we have any bond issue cost, if incurred, it will be recorded as an expenditure. This is the general entry for the capital project fund. Okay, for the same transaction, if we record it for government-wide statement, we're going to have the following transaction, which looks like exactly the same as in financial accounting, intermediate financial accounting. However, this entry is not made on the books. Okay, it's not made on the books. So it merely is the entry we record this entry to show the difference between the capital project fund and the government-wide statement. These are the entry we actually record. But on the financial statement for the government-wide reporting, we want to show the results of this one. So by the end of the year, we're going to convert these journal entries back to this result. Okay, so there are adjustment we're going to make if we want to have the government-wide financial statement. Bond issued with a discount. In capital project fund, we're going to make this journal entry with debit cash. So you see this is lower than the face value, so we have a discount. The discount will be recorded this one. We debit other financing use, bond discount, and then credit other financing source, bond proceed. And if we issue 5 million bond and we receive 4.95 million, which means we don't have enough money to complete the project. The project we expect to use $5 million. So we're short of $50 million. Okay? And because of that, we're going to ask money from the general fund. We're going to ask $15,000. Ask for $15,000 from the general fund. So we have debit due from general fund, it's a receivable, then credit other financing source, transfer from the general fund, $50,000. So that we can have 5 million to start the project. Alternatively, we can revise the budget for the project and reduce the total spending to $4.95 million. Okay, either way will be fine. But usually we're gonna transfer money from general fund to make $5 million. And in government-wide statement, it looks like this one. Again, this is not recorded. Okay, we want final results to be this one, but this is not recorded. If you want to report government-wide statement, we're going to convert those numbers to this one. Grants. No, grants is also important. Grants are also important for the project fund. Again, assume approval is obtained for a federal grant as partial funding for a city's office building. Upon approval, we're going to make this journal entry with debit due from other governmental units, then credit revenues, $100,000. So the difference between the grants and the bond is, for grants we record the revenues, bonds it's other financing source. Okay. Then when we receive the money, we debit cash and credit due from other governmental units. Then in capital project fund, then when we start project, we're going to record all the expenditures. That's we're not going to see. Just record our expenditures. That's it. We do not record any capital assets in any governmental fund. Next, let's talk about debt service funds, DSF. So these are the accounts for and reported financial resources that are restricted, committed, or assigned to expenditures for principal and interest on all general long-term debt. So we use this fund to pay principal and interest. This is required when legally mandated or financial resources being accumulated for principals and interest payment that come due in future years. Right? So it's either legally mandated or the financial resources being accumulated for principal investment payments come due in future years. So if we have a long-term liability to pay for multiple years and we want to accumulate resources, right? We need to use a debt service fund. However, this fund does not include debt issued for and serviced by enterprise or internal service fund and some other trust fund. So this is reserved for governmental fund. Other fund like enterprise, internal service, those are proprietary. Okay, they are business related fund. They can also issue bond. And then they can service bond. Okay, well these are not included in the debt service fund. Debt service fund only recorded debt service for the governmental fund, basically, or governmental activities. Again, we're going to use modified accrual basis. Modified accrual basis. If we use modified accrual basis, right, everything will be recorded, or the payment will be recorded as expenditures. And we do not recognize long-term liability. Remember? Interest and their principals are not considered current liabilities of DSF until the period in which they must be paid. But there's an exception. But the interest revenues on bond held as investment is accrued. So we do not accrue any interest, principal payment, do not accrue. Right? In the period when we pay, we're going to record them. But for interest revenues, as on bond held as investment, we accrue the revenue. This is something special for interest revenue. So how do we report long-term liabilities in debt service fund? Right? Because in all the governmental fund, we do not report long-term liabilities. Okay? So we report long-term liabilities when they are due and payable. Okay? When they become due and payable, then we're going to record a long-term liability. Otherwise, we do not report them. Option to record a portion of long-term liability before it is due and payable. Again, there's an option. At the end of its fiscal year, a government may record a liability and associated expenditures for debt service payment met within the first month of the next fiscal year if resources are available in the debt service fund for the payment. Okay, so usually as we have seen in the previous slide, we do not accrue, right? We do not accrue interest and principal payment. But there's exceptions. It's right here. If we have money available, resource available, right? And we may record accrue a liability and record expenditures for a payment for the next month's payment, basically. The next month's principal and interest payment, only for the next month, for the first month of the next fiscal year. That's it. So it can only accrue for 1 month's interest and principal payment. Interest on long-term debt. We know the interest is not accrued this time. It's not recorded as an expenditure until it is legally matures, due and payable. Right? And we have seen this in the previous slides, option to record it, right? It's only fiscal year end. You can only accrue for the 1 month. The next month's interest, we can only accrue 1 month. Most government appropriations only include principals and interest that come due during the fiscal year. Okay. So when they make the budget, we only include all the principal and interest due within the fiscal year. Right? Any payment beyond that, future years, right, they not show up in the budget. So if they're not shown in the budget, okay, for government fund, debt service fund, we do not recognize them. Example: assume bonds are issued January 1st, 2020 and pay interest semi-annually January 1st and July 1st in the amount of $100,000. Okay, so we pay interest twice a year. The fiscal year ends December 31st, 2020. How much expenditures will be recognized in fiscal 2020? Right, it's very clear that for fiscal year 2020, only one payment, $100,000, which is paid on July 1st. It's only one payment, so we can record $100,000 expenditure. And we do have an immediate payment the next day, January 1st, 2021. But obviously, this option, right? This option is not used. This is an option. We may record the next $100,000 as an expenditure. But unless the question says clearly we use that option, otherwise we're going to assume this option is not used. This option is not used. So we only record what has been paid during the year as expenditure. We do not accrue any additional interest. Another example. A certain city issued $100,000, 6% zero general obligation bond, December 1st, 2020. In addition, interest of $3,000 is due on June 1st, 2021, December 1, 2021, and in decreasing amount every June 1st and December 1st. For the next 19 years after that. The first principal maturity of $5,000 is due on December 1st, 2021. Right? This is a zero bond, and because we pay principal back every period, so the interest amount will decrease. Interest amount will decrease. So let's record these transactions in the funds. First, let's start with the capital project fund to recorded a bond issuance. Debit cash and credit other financing source. The zero bond, right? So the bond was issued at its face value. There's no discount or premium. Okay, next we're going to move to debt service fund. So the first thing we're going to do, we're going to in the debt service fund, we're going to do the budget. So for the fiscal year 2021, we're going to basically pay principal back $5,000, and we have to pay 2 interest payment, each $3,000 each. So that's $6,000. The total we need to pay $11,000. Okay, so the budgetary entry is we debit the source. We need $11,000 money. We debit estimated other financing sources. So for the debt service fund itself does not have any source. We're going to get a source from somewhere else. We're going to credit appropriations principal, appropriation interest. The source we're going to get money from is the general fund. So we're going to debit due from general fund, okay, and a credit other financing source. Transfer from general fund, $11,000. Okay, then on May 28th, 2021, we're going to transfer money from the so we're going to transfer money from the general fund. Okay, here we have a typo. I'm going to correct it. General fund. So for the general fund, we're going to debit other financing use, transfer to debt service fund, and credit cash. And for the debt service fund, we're going to record the receipt, right? Debit cash, then credit other financing source. Right? If we accrued like this one, then we just debit cash and credit due from general fund. Okay, if we have accrued. Then on June 1st, when we make the payment, we debit expenditures, bond interest, and credit cash. On the government-wide statement, we're going to show this result: interest expense and credit cash. Okay. Again, we only record this journal entry, the expenditures. We do not record our interest expense, but if we want to report government-wide financial statement, eventually we're going to convert all the expenditures to expense. Okay, to expense. If the remaining $8,000 transfer was received, okay. Then December 1st, we're going to pay the principal $5,000. We're going to pay interest $3,000 and the credit cash. So if we are recording this in the government-wide statement, it should be debit interest expense, right? Debit bond payables and the credit cash. Again, we only recorded these journal entries, and if we want to report a government-wide statement, we're going to convert these results back to this one. And finally, closing entries. Closing entries. By the fiscal year end, we're going to close entries. The closing entry is very similar to the closing entry you have seen previously, right? Because we also have the budgetary entries, so we combine these two together into one entries. Okay, so the appropriation, we debit appropriations, debit appropriation interest, and we credit estimated other financing source. We close these three items. By recording these three items, we close the budgetary entries. Then we close all the expenditures and other financing source. We debit other financing source, we credit these two expenditures, and that's it. So for the same transactions, how do we adopt the government-wide statement? We would have recorded this one to close. Basically, we close the interest expense. This is the only expense we have, right? Close expense and debit, reduce net asset, unrestricted. Another example is with interest. So a village borrowed a loan, $90,000 on an installment basis with 3 annual installments, $36,190. So 3 payments. The amount required to liquidate a loan of $90,000 over 3 periods at an interest rate 10%. Okay, in other words, the present value of the 3 installment payment should equal the loan amount, $90,000, when interest rate is 10%. Right, so when we pay the first payment, which is $36,190, it includes a principal payment and an interest payment. Okay, and the amount of interest is based on the outstanding loan amount. The present value, outstanding present value loan amount, and the 10% interest. Okay, so we debit expenditure interest $9,000, and the difference between these two will be the expenditure principal. And for the next $36,190 payment, the next year, okay, because the our principal amount, okay, the present value of the principal will be reduced, so the expenditure of interest is also going to get reduced. Then the expenditure principal, this amount will increase. Okay. Special assessment are most common other financing sources. They are levied when taxpayers in areas beyond government jurisdictions wants to benefit from certain facilities and services. So, for example, resident in the county wants to get the water service from the city, right? So the government are going to spend to set up a project, water project. So who's going to pay for it, right? The resident, right? So in this case, Gatsby said that government is obligated. Government is obligated if it is responsible for the debt in the event of the property owner default, or it is legally liable for assuming the debt or gives indication that it may honor the debt in the event of default. So in the water project case, right, the county, they're going to the group of resident. The group of resident is going to basically issue, right? In theory, the group of resident who's going to benefit from the project are going to pay the money, right? Not government. But because it's a government project, so the Gatsby is very clear that if the following conditions are met, then the government is obligated for the bond issued, right? It's responsible for the debt in the event of property owner default, right? If the property owner, they're going to pay for it, the government is going to pay for it. So if the government is obligated, okay, the government accounts for debt service on special assessment debt in a DSF, debt service fund, where the government is obligated. If the government is not obligated, okay, both the special assessment debt and the debt service are accounted for in an agency fund, which is the fiduciary fund we're going to talk about in later. Fiduciary fund, okay? So it's not, it's government is doing this for the resident, but it's the debt and the asset are not part of the government, okay? They're not part of the government. So it's agency fund. But this will be disclosed in the financial statement. So if there is a special assessment, we have to differentiate whether the government is obligated or not. Okay, if it's obligated, we record it as if it's a government's project and record within the DSF. Right? If it's not obligated, then we're going to record it in an agency fund. Special assessment debt is sometimes paid from a proprietary fund, sometimes, which is a business type fund. Sometimes, in this case, all transactions are reported in the proprietary fund. Okay, and because it's a business type fund, improvements financed with assessment should be capitalized, in which we use the full accrue basis. Examples: we'll have 1 million special assessment were levied on property owners in a special benefit district, payable in 10 equal annual installments. Government is obligated in this case. Okay, obligated. So we know we're going to use the debt service fund. So in the debt service fund, we're going to record the debit assessment receivable. This is for the current assessment, and we have to defer it for future assessment. And because we're using modified accrue basis accounting, right? only the current part will be recognized as revenues, and all the deferred one will be deferred revenues. So we credit revenues 100,000 and credit deferred revenues $900,000. So when the first assessment is collected, the government also applied 8% interest on the outstanding balance, unpaid balance. At the very beginning, that's going to be $100,000, right? So 8% of that will be $8,000. So for the first assessment payment, that will be 100,000 current assessment and 80,000 interest revenue. So total $180,000 will be debit cash. Now, once we have the fund, the government is going to pay for the bond. Right, it's the same thing. The government is going to credit cash 180 and debit bond principals and debit the expenditures bond interest. Okay, so just collect 180 and then they're going to pay 180. Early next year, the following reclassification entries will be made. So for the next year, early next year, the deferred receivables will become current, right? And then the deferred revenues, accordingly, deferred revenues, 100,000 deferred revenues will become revenues. Okay. Then we're going to repeat this process, basically. But the amount of interest will be reduced, right? Interim financing. Interim financing may be necessary to obtain interim financing until proceeds from intended sources are received. The problem with the government, especially those relying on tax, is, right, the government collects tax only in a certain time point. For example, collect tax near the year end, but in the middle of the year, the government may not have enough cash to support its service. So if that happens, may consider an interim financing, which the interim financing are used often to complete architectural or engineering design during pre-construction phases. And also you can start a project before you actually collect tax. So let's see one example. Assume for the office building project, $50,000 was borrowed from the general fund to be repaid later from bond proceeds. So debit cash and credit due to general fund, we have seen this before. And when it's repaid, debit due to general fund and credit cash. Okay, that's it. That's interim financing. And on the government-wide financial statement, as you can see, this is just a borrow and repay among the fund. So government-wide, these two can offset with each other, right? Because if you have due to general fund, then on the general fund side, they will have the due from capital project fund, and those two will get offset with each other. Government-wide, there's no effect, so no journal entry is needed. Arbitrage. Arbitrage is a kind of investment of idle cash. The government can issue a debt at lower tax-exempt interest rate. So this is the benefit. Okay, and investment of proceeds in taxable securities yielding high return. So they can borrow money at lower interest, then they can invest those proceeds to earn high return. Okay. Is that reasonable? Right? It's not reasonable, right? Because you're taking advantage of the government, taking advantage of federal government especially, right? Because for other business organizations, if they borrow money, okay, if they borrow money, those are not tax exempt. Interest are not tax exempted. So there is arbitrage restrictions. The state and local government must observe arbitrage regulations. Okay. Basically, either you don't do that, but if you do the investment with the proceeds from the debt issuance, the investment revenues should be reduced and the rebate liability established. Basically, you're going to return money back to the federal government. Debt refunding. Similar to refinancing, right? This means that existing debt is replaced with new issued debt. Hopefully, the interest rate will be lower. For example, bonds traded on the open market can be repurchased at the going market rate. Especially this going market rate is lower now, right? And existing debt may have a call feature that lets government repay face value early. Sometimes this call feature. So the issue with the debt refunding is when issue new debt, okay, so here we're gonna correct some typos. When the government issues new debt, okay, new debt, so they're gonna do a refunding pretty soon. They're gonna debit cash. Okay, this is debit cash, and then this is credit. Credit, other. Credit operating financing source, the proceeds of refunding debt. It's a source, incoming source. Then to retire the debt, to retire older debt, you're gonna debit. This is debit. Okay. I don't know why there's so many mistakes in this one. You're gonna debit. Other financing use, refunded debt, and then credit cash. Okay. In substances, defenses. If a government had to retire outstanding debt by repurchasing it in the open market and then paying a price reflective of current interest rate, then there would be no benefit of refunding. Right? But if you have to borrow at the current rate, then retire the old debt with the current rate. Right? You're not going to benefit from it. Right? Only when? Only you have a call price. If you have a pre-set up call price, this price is lower than the current market value of your old debt. So you pay less. You can pay less to retire old debt. Then you borrow money at the current rate, which should be lower, to retire the old debt. Then you're going to benefit from it, from the transaction. Okay? So the problem with the call price is there's a time restrictions. So when you borrow money, for example, they have a call price, but they put a time restrictions. For example, you can call after 10 years, for example. Okay. So now we have a new term here is in substances defiances, which means we don't have to wait 10 years to refund this old debt. We don't have to. Okay, this is what we're going to do. Okay, so if the government determined to refund the debt, when they can issue the new debt, the government issue the new debt, they can place the proceeds in a trust, sufficient funds to make all required interest payment through the earliest call date and to redeem the debt on that date. This is called in substance defiances. In other words, you can borrow another money, then put it into a trust fund. Okay, then you're going to use the proceeds from the trust fund to pay interest payment and then pay the call price when the time arrives. Earliest call date. Okay, so you have two debt going hand by hand, and they will call this in substance defiances. What does it mean? It means that in substances your old debt has been refunded already. Although it's going to happen in 10 years, but because you have set up the trust fund, okay? And in substances, the old debt has been paid off already. If that is the case, if there's in substance defiances, a government may remove the existing bond from its schedule of long-term obligation and replace them with a new bond. Okay, so we only reported the new bond only. Report a new bond only. We're going to remove the old debt. Okay, this is pretty much for this lecture.